Hey traders, this is Blake Morrow with Traders Summit. And with me for the very first time is Mr. Chance Finucane from Oxbow Advisors, and you're the Chief Investment Officer there. How are you?
Doing great, Blake. Thanks a lot for having me on the show.
Well, it's great to have you on the show. And, you say you're doing great. The equity markets, maybe not so great. And I was just having some conversations with other traders in the community talking about how bearish the price action is, where we're having a very difficult time lifting off even the 3,900 level, and we're getting a foothold below 4,000 in the S&P. How are you navigating this very tumultuous market at this point?
Yeah, what we're doing right now is I think we, over the course of the last few months, have been raising a lot of liquidity across all three of our strategies that we manage for clients. We have a stock portfolio, a portfolio that focuses on generating a lot of dividend income, and then one that's just very conservative, trying to be bulletproof. And for each of those, we have anywhere between 40 to 50 or 55% in cash or short-term treasuries. And the reason behind that move is us seeing this change both in Fed activity with tightening and raising interest rates, and then also seeing this slowdown in the economy. And for us, we've really been looking at valuations and seeing that the S&P 500, for instance, over the last 30 plus years, on average, it trades at about 16 times forward earnings. And even today, given how far it's fallen, you're still trading slightly above 16 times. And I'm sure like if something's coming down from a peak in valuation like that, it's not going to stop right at the average. It's likely going to run through. And if we look at the last two bear markets, in 2018, the market bottomed, I believe, between 13 and 14 times earnings. And then in March 2020, I believe it bottomed between 12 and 13 times. So for us, 14 times forward earnings, if those earnings hold up, which is a question after companies like Walmart and Target have taken down guidance, but if those earnings hold up, 14 times earnings puts the S&P at about 3,300, which is about 16% below where we are today. So for us, we're starting to see more companies that look undervalued and are on our monitor, but we're really not doing anything with that because we think if that's where the end point is at some point in the months to come, let's see where we're at when it gets to there.
Well, that's a great way to look at the market, especially when you're looking at earnings, because bottom line, that's what matters at this stage in the game. Thinking back in previous bearish cycles that we might be in right now, people really start looking at those companies that are producing earnings and maybe even some that are producing dividends. So what type of stocks are like on your radar right now? I know you'd mentioned that you may not be looking to put money to work right now, but what are the types of names or any names that you might be on your radar?
Sure. Well, I think it's sort of two different factors in terms of what you would like to have in your portfolio now. If you could build one, if you had to own things in this environment, I think you probably still want to be skewed more defensive. But the thing is, a lot of the defensive sectors like consumer staples and utilities and even healthcare have been bid up to levels that on an absolute or a relative to the market basis have gotten a bit expensive. So you're seeing even those come down, like some of the big consumer staples names went down by a lot recently on that Target report. So while you want to be more defensive in the near term, I think where we're seeing stocks being undervalued is in the consumer discretionary and the technology sectors. Now, we're not looking to jump in right now. I can give you a couple of good examples for why we think this downdraft has further to go. But that is where we're seeing the undervaluation. So that's one area. And then one thing that we've talked about a lot in-house here is that we think the rest of this decade is going to have a lot more uncertainty and volatility to it, similar to what we've experienced the last couple of years. And given that, I think we're going to try to have more balance in our portfolio across a range of sectors. So if we see a sector or an industry hit a level that we think is undervalued, we'll try and pick out two or three names that we really think are top tier players that we could own in the intermediate term. But for right now, I think we're still looking at that defensive slant and just trying to monitor this as it keeps moving lower.
Yeah, I mean, as unfortunate as it is in bear markets, it tends to take down everything. And I guess, maybe even losing the least amount of money is the name of the game in a defensive posture, right?
It really is. If you think about, and I'm sure everyone watching this realizes, if you have A portfolio that goes down 10%, you only need to go up 11% to get back to break even. But if you go down 25, now you got to go up by 33%. You go down by 50, you got to double to get all the way back. So it really pays to try and preserve what you have during an environment like this so that you don't have to necessarily double your portfolio once you finally bottom out. Is even though things were easy the last 3 years for markets doubled from start of 2019 to the peak at the end of last year, that's not normal. And you can't bank on a double within 3 years to get back to where you want to be.
Sure, absolutely. So let me ask you, how much is the Fed in your playbook right now? I mean, we've obviously had a Federal Reserve that looked at the inflationary pressures. They thought they were transitory. Obviously, they weren't. They're playing catch up. You got central banks almost globally tightening monetary conditions, and you could argue that tightening means, hey, stocks are going to come down a little bit. What do you think the Fed might be able to do to maybe slow down this rate of decline that we've seen in equities, or is there anything?
Given their plans, I don't think there's anything that they're planning or hoping that they'll be able to do over the next 18 months that is going to slow this down. I think they're just hoping that not too much damage is done and that they do not break anything. But really what has changed about the Fed's mentality now compared to the previous 12 years is that they are now far more concerned about inflation than about promoting employment in the United States or keeping the stock market up. The 40% of US households that live paycheck to paycheck and having to deal with 8% inflation, that is their priority rather than the 10% of households that own 90% of the US stock market. So given that focus, I think they're going to, right now, the market's implying 100% chance that they're going to hike rates by 0.5% both next month and in July. So now you're talking close to a 2% Fed funds rate in 2 months. And the other factor that actually is really important that maybe doesn't get quite as much attention is they're going to start reducing the Fed balance sheet next month. And if you look at when they did that in 2018, you saw some significant changes under the surface, especially in the credit market, where long-term treasury yields went down, the spread on high yield bonds increased, and it got to a point that then the Fed finally did break something and needed to reverse and stop tightening and start easing. And so I think until you start seeing signs of that, that would be the thing that maybe puts a bit of support to the market.
One of the things that I've been kind of toying with as far as an idea of myself, just trying to put it all together here, is the Fed's most powerful tool is their rhetoric, right? It's their words. I mean, they can pull a few levers here and there, but really, marching every Fed, regional Fed president and around the country and around the world and having them talk is really a very powerful tool in their toolbox. Could they get to a point, I'll ask your opinion here, do you think they could get to a point where they might actually sound a little bit more dovish? But we'll get to that as they get to a rate, a FOMC policy date. They end up still raising rates, but in the meantime, they may sound a little bit more dovish just to kind of try to burden the slowdown. You have any thoughts there?
That certainly could be the first sign that you see that they're on the verge of changing policy. And I imagine investors everywhere will be paying very close attention to when that rhetoric changes. But for now, everything that we're seeing, both with current governors on the board and former Fed governors, which are probably out in the media just as much, everyone is saying that they need to raise rates and inflation is the top issue. You got to get back to a neutral rate in the short term. And so, like you said, until we see something different, I don't think you can try to anticipate that. But that may be the first way that they try to change the tone and change investors' perspective.
Yeah, and then Jackson Hole is a long time away. I keep thinking, where is Jackson Hole on my calendar of events? Oh, it's after summer. Darn it. Anyway, let's talk a little bit about inflation. So inflation obviously is on everybody's radar right now. It's a election cycle. You're seeing, politicians run on that platform on every, in every facet of inflation. But where do you guys stand at Oxbow Advisors? Are we going to be in a stagflationary environment? Is it disinflationary? What are you seeing?
I think all those definitions are relative depending on a person's perspective, but to try and put some numbers to it, We think the economy is slowing in growth, that there's a significant risk of recession either this year or next year. So that's one component to that sort of stagflation idea. And while we think inflation could start coming down over the course of the rest of the year, it may remain a bit higher than people might anticipate. I think the Fed's hope is that we get back to 2 to 3% inflation by the end of the year. And yet you're seeing data points suggest that maybe that's more like 5% or still closer to 6% by the end of the year, which is going to put them into a bind as to whether they want to pause on this tightening if it's starting to really hurt financial markets in a major way, or do they want to keep trying to fight this inflation by reducing demand and raising rates. One area that we look at that actually historically has a good track record of predicting what inflation will look like 12 months from now is the Atlanta Fed tracks the sticky CPI, which is the components of the inflation calculation that don't change as frequently. So this might be like medical care, education, your housing or rent costs, auto insurance, things that are not going to fluctuate as much. And if you only look back about 6 or 9 months ago, it was still sitting at maybe about 3%. The sticky inflation number now is 7%. And I'd say that's a little bit concerning that you see this many sort of services related costs increasing at that rate. It might suggest that even if food and energy costs come down, you might see a bit higher inflation number than people thought.
Wow, that's something, and it's hard to think about, especially with, as you pointed out, 40% of American households living paycheck to paycheck. When those costs that are kind of entrenched in their monthly bills, as those go up, it really will affect consumer spending, as we're seeing in companies like Target and Walmart as of late. I want to ask you one last question before we go. The dollar has been obviously just rip roaring. People will attribute it to all sorts of things, but the dollar had touched 2017 highs. And we were seeing levels we hadn't seen in quite some time. It's come off a little bit. It's near those spike highs that we saw during the COVID lockdowns when everybody panicked, everybody ran to the dollar for safety. Well, we're easing off those levels right now, but I want to ask, does the dollar impact your how you approach the markets over there at Oxbow?
It's something that we keep an eye on. So historically, if you have a recession, that tends to do specific things across different parts of the asset market. So you might see long-term treasury yields go down. You obviously would see a downward move in the stock market, but it also tends to lead to a strengthening of the US dollar because that's the safe currency around the world that people might run to if things really slow down or even turn to a decline in the economy. So that's one factor that if we think we are seeing this slowdown, that could provide some persistence to this strength in the dollar. The other thing to monitor within that is how the different central banks are acting. So the US, because we had so much fiscal and monetary stimulus the last 2 years, even more than in Europe or Japan, we are now the ones trying to tighten the most. And that's what's creating this US dollar pressure or strength. And in the meantime, in Japan, for instance, they're fighting so hard to try and keep their long-term interest rate at 0.25% that they're pushing more of their currency out into the marketplace. And that's why you've seen such a weakness in the Japanese yen. That's something that I don't know that we'd see anything play out differently. I mean, this could certainly continue. But if the dollar is strengthening like this, that likely means that you would expect continued weakness in the equity market. And then potentially some growth in price of the long-term treasury bond.
Well, that's a really good way to sum it up. And the dollar, even though it is weakening a little bit, the thing about the dollar also, and let me get your opinion here, if you would agree. One of the things that's been maybe our saving grace from an inflation standpoint, at least at the producer level, is that we've had this stronger dollar, and that's kind of curbed some of those inflationary pressures. So what would happen theoretically? Let's say the dollar had a 5% or maybe 8% haircut from here over the next couple of months. Do you think that would fan the inflation flames, if you will?
It could. I think, for us, we're trying to consider a little bit more longer term that. So I don't know that we've got the same expertise on a very short term move like that. So I don't want to try and make a forecast on that front. But typically, yeah, if you're going to see weakness in the US dollar, that could lead to some strength in commodity prices. But what we would say is with this economic growth slowdown, what that usually leads to is there will be some deceleration in the inflation rate. And you will see a bit lower government bond yields over time. So that may be a bigger factor than a little bit of weakness in the US dollar. You just have to see how those two offset each other.
Wow, that's that's a great way to kind of wrap it up here. And I really enjoyed our conversation today. And as traders, we're always looking for those themes to trade on in the markets. But I know after this interview, we're gonna have a lot of people that are wealth managers, kind of wondering what you guys do over there at Oxbow Advisors. Can you tell us how we follow your work?
Sure. The best way to reach us is to go to our website, oxbowadvisors.com. We usually keep up numerous videos, especially with our founding partner, Ted Oakley. You can read our most recent quarterly letter and quarterly market update that we film and release on YouTube to get a good sense of how we're seeing the market. And we always keep those updated so that everyone can keep track of how we see the fluctuations and changes, which are especially relevant now with how fast things are moving.
Well, Chance, I want to say thank you so much for joining us today and blessing the Traders Summit community with your presence. I hope we get to do this again because I really actually enjoyed going through all the different market dynamics with you, and let's do it again soon.
Yeah, this was terrific. Thanks, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.